What is up, everybody? Logan here again with another video coming right at you. We've had a lot of requests for this, which was to get Vance on to talk about his SPX iron flies that he takes on a Monday, Wednesday, Friday basis if the market permits, right? And that's one thing we've gotten a lot of questions on. So we're going to go over it in depth for you guys, how we take it, kind of our profit goals. And I'm also going to share a story towards the end about how much I've made so far on it. And I've only had one loser so far. So it's been a great strategy. I appreciate you coming back on, Vance.
Hey, glad to be here, Logan. So, talking about the zero date expiration iron fly, I'm gonna give a brief little history, not to bore everybody, but basically, this strategy was popularized by a guy named Jim Olson, and it's kind of all over the internet. You can look up his strategy guide if you feel so inclined. I don't recommend it, uh, which I'll go into why in a minute. But basically, it's a strategy that basically says, hey, we're going to put an iron butterfly on SPX at the start of the day, and we're going to try to capture some theta and vega off of it and shut it down. And if everything goes according to plan, we'll make 150 bucks really quick. Part of the reason why I'm not a big fan of his way of doing it is because he basically advocates starting up this play like the moment the market opens. So like the moment you hear the opening bell, you basically count 10, 15 seconds in, and wherever SPX is at, you make that trade. And that's what he wants you to do. And then his idea is that within 20 or 30 minutes, a lot of the volatility from the market is going to evaporate, and you can close this out and make 150 bucks pretty quickly. The problem is, and this is where a lot of people run into problems with this particular strategy as it's outlaid, is that normally in the first 15 to 30 minutes of the day, the market just goes insane. It's all over the place. And even the past few weeks, we've seen 20, 25 point swings of XPX just in the first 10 minutes of the market. I mean, I think on Monday, SPX just within the first half an hour of the market, it was up 45 points from where it started.
Yep.
And you're going to have a max loss iron fly when you do that type of strategy. So our basic way of doing it is very similar, but we take a step back. And I kind of liken it to crossing the street. Nobody goes out, and normally before you go to cross the street, you look both ways so you don't step out in front of a semi, because you don't want to get hit by any type of automobile, because that'll land you pretty fast. We're going to do the same thing. We're going to wait for the market to open, and then we're going to stop. We're going to take a breather, and we're going to see what exactly the market is doing on this given day. So the indicators that I like to use are a collection of them, which I'm going to show up here, which are going to be the AD, the ADS PDC, and the tick. What these indicators are going to give us is an indication of how the market is moving. So what AD and ADS PDC and tick all basically measure is stocks that are going up and down at any given time. The AD is the collective market. The ADS PDC is the S&P 500, and tick is pretty much the entire market as well. And what it's going to tell you is how many stocks at that given moment are going up or down, and you're going to get a positive or a negative number based on that number. And what we generally find is, in most cases, the S&P 500, the SPX, or the SPY is going to move generally in the same type of wavelength form that these move. So you can kind of see how, here in early afternoon today, we kind of had this kind of reverse head and shoulders going down, and you can see how the S&P 500 basically did the same thing over here on the way down. So, and then as it kind of went up in the afternoon, it kind of went up here. So for the most part, we see a lot of convergence in these waveforms. That's not always. Sometimes we have some serious divergence. You can see in the morning here, we had this couple big green wicks. And really in the morning here, we actually had some red wicks. So sometimes you do have some divergence. And that's one of the reasons why we don't want to just throw this on right as the market opens, because, you know, obviously from where we started, right, we moved up almost 10 points in the first few minutes of the market. So if you would drop that iron fly right here at market open at close to, you know, 42.55, right, all of a sudden now you're 10 points up from there instantaneously. And on a day like today, where the expected move was like 13, right? You're only going to be getting enough credit to really cover about 20 points in either direction. And what ends up happening is you're going to blow out your stop losses, or you're going to be really close to blowing out your stop losses, and you're not going to be making any money. So we really want to make sure that we're stopping, we're looking at these indicators, and primarily what we're trying to find is what direction is the market moving. When you look at add and you look at, well, let's start with add, right? So I've drawn out some lines in add here, basically at the 0 and then every 500 up and down. Basically, the longer that one of these indicators stay in one of these realms, that indicates a greater momentum in that direction. But also, as long as it's staying in that realm, you're going to get some sideways movement. Really, the only time you get the up and down function is when it moves through the range. So you see, like collectively here, when we're moving, and this is actually a daily chart right here, but you can kind of see over here, like as we're going up, we're moving generally up. So, but if you're staying inside the same range, even though you're moving up and down, you're not seeing as much actual movement. You're only seeing a few points of movement here, even though you are still moving up and down. Yep. So what we're looking for is to see if we can get some degree of where's the market going, you know, and what's actually interesting is if you counted, these are 5-minute bars. So if you looked at this one right here, you count 1, 2, 3, 4, 5 bars in, right? If we were like, okay, we're going to be somewhere in this range right here, even though we had a couple red bars in here, let's say this is kind of our point. Now we're 25 minutes in, so now it's like 9:55. If you had bought in at that point and you pinned right there, this is going to be really interesting. What we're going to find is at the end of the day, we actually almost pinned at that spot around that 42.66 mark. Yep. So if we had waited to right about here to buy in, that 15-25 minute mark, and actually put our iron fly on right there, we would have been up and down all day, but close to the end of the day, we would have almost bullseyed it. The reason why that's important is because the way this trade makes money is it's a net credit trade. When we go in, we're going to get a credit of $1,500. If we were putting this on for tomorrow, hypothetically, we'd be getting a credit of $1,580. I'll get that spit out correctly. We generally go 50 points wide for the protective put and the protective call. So we're going to put in a collateral of $3,400. What's going to happen is as this price stays closer to this point, Vega will theoretically decay. That we'll see that in the expected move lowering. And of course, we'll get theta decay as time goes on in the day. So if the price stays close to our pinpoint, we're going to decay the price relatively quickly. And if we put this trade on, let's say at 10 o'clock in the morning, Eastern time, market time, by 11 o'clock, we could already have $200 in, and we can cash out. Now, if we're really confident in our pin, which is why we kind of wait, because we want to be hyper confident in that pinpoint. If we're really confident in that pin, you actually can stay in the trade a lot longer. And if you were to stay until 12 o'clock, you might be able to get $350 out of it. Now, what ends up happening is that because the way the market volatility works, after 12 o'clock, there really isn't a lot of market volatility until power hour at 3 p.m. So what you're going to find is that whatever the expected value is, you're only going to lose about 10% additional, generally from 12 o'clock to 3 o'clock. So, if the original price was going to be 15.80, we might lose another $1.50 out of it in that 3-hour time frame. But, collectively, if you've held it all day, you could be up to $500 at 3 o'clock. Now, from 3 to 4, that's when volatility and theta and everything kicks into overdrive because the market's going to end. The day is closing. And, on today, we actually had a fairly calm day. And I tend to find that Tuesdays and Thursdays, because there is no expiration in SPX, are usually a little bit calmer. But, if you actually had this, so like this right here is actually yesterday. You can look at the S&P from yesterday, and you could see in that last 30 minutes, boom, we dropped like a rock. But for the most part, all day long, pretty much from about 1 o'clock to about 3 o'clock, we were pretty solid. This would have been on Wednesday. So, but today we were pretty calm. So if you actually could get that pinpoint, right, you can end up holding it till almost expiration. Or if you're a really, really ballsy person, maybe you will hold it till expiration. You could get close to $1,500 if you pinned it right on, it's right at the exact point. I don't necessarily recommend that. I personally, if I was going to hold it most of the day, I would probably get out at 3:30, 3:45 at the absolute latest, because we do get a lot of those crazy swings in like that last hour, even the last 15 minutes. The last 15 minutes on Tuesday, again, like we dropped in them, or we went up and then we dropped in like just the last 10 minutes. So I don't necessarily know if I would do that, but that's something you can do. And because we actually take a few minutes out of the day and say, where do we think this is going to be? We just don't throw something up at the wall and say, all right, if it hits, good. If it doesn't, oh well. And a big reason for that, and I want to share this, is I've done some analytics based on what people have reported they've made or lost. Jim Olson reports that this strategy has approximately a 70 to 75% win rate. So, and just by looking at, going back to the screen here, just by going at the trade analytics, right? If your break-even point is going to be the edge of the triangle that you're in, take my other play off of there. What you're going to find is that when you reach the outside of it, your profit loss is going to be close to $600 if you break this tent during the day. And obviously the later into the day, the profit loss might not be as high, but early on in the day, if you blow this out right away, you're going to be at a $600 loss. So basically, by doing some analytical analysis over expected win-loss rates and expected time, what you're going to find is that if you have a 70% win rate, and when you win, you only collect 150, and you lose $600, over time, you're going to lose $7,500 on this trade. Mm-hmm. And that's the Jim Olson way of doing it. I'm not trying to disparage the guy. I'm just trying to lay out some straight factual numbers as they come across. Even if you give yourself a hard stop loss of $400, you're still net losing $1,500 over 100 occurrences of doing this, because you're only taking $150 when you win. And in this case, you'd be losing $400 when you lose. And I'm going to tell you that anybody who's done trading for more than 5 minutes, will come to realize that when you lower your stop loss, you organically lower your win rate because you get stopped out of trades earlier than you would have. So that's one of the reasons why we advocate this stop and wait mentality, the stop and wait strategy. You know, do some analytics, see what's going on with the trade, you know, see what's going on with the day with the SPX, and look before you leap. If you're going to put this trade on and if you're not going to use SPX, you can do it in SPY, but you obviously have to do it with you know, larger amounts to get the same profitability level, because SPY is 1/10 of SPX. But you know, you got to be careful if you're going to use it on something like RUT, because the volume on RUT is just horrible. So you can get into the trade, but you know, one of the key parts of it is you want to be able to get out of it when it hits your profit levels. You know, when you're comfortable getting out, and you could sit in with RUT when it's profitable, and then it takes a swing and it's not profitable anymore because you can't get out of the trade.
Yep.
I know we experienced that in the group a few weeks ago with a RUT trade where we just couldn't close it in a timely manner. It sat there for half the day.
And it still worked out, but yeah, it sat there and
it's right. And it did work out, but yes, we sat there for a lot longer than a lot of people were comfortable sitting there. So
I was gonna share my story real quick about SPX.
Yeah, absolutely.
And the Ironfly. So first off, I want to say if you guys want to join and follow along with Ice Bear and Vance on their plays, you guys can do that in the Discord link below. But I've been trading them for about 3 weeks now, and I'm up probably $3,000. Now, I did take a loss on Monday. I know you guys got stopped out at $400 from credit received. I waited and I got stopped out at 700. I made that all back on Wednesday with the Ironfly, but my big gain was one that I held till 345 last Friday. I held one till 345 and walked away with $1,075 on the trade. And I had 2 lots. I got in a little later on it than everybody else did. And I was like, all right, since I got in later, I'm going to hold this. The setup's still there. And yeah, I closed it. And the crazy thing about the last 15 minutes is I missed out on an extra $330 if I would have held it another 5 minutes and closed it at 350. And then it actually pinned about 3 strikes or 3 points away from my strike. And I probably would have made a little bit more. I know it gets a little wonky when you hold it to expiration, but I'm definitely getting out before 330 from now on, not holding into expiration because of the wild swing that I saw at the end of the day. I mean, there was a point where I would have been upside down with like 3 minutes to go. And I was like, what? You know, like I wasn't still in, but I'm analyzing the trade still after I had closed it. And I'm watching this thing move. I'm like, okay, so I'd have made an extra $300 there. Oh, now I'm upside down. Oh, okay, almost max profit. Like it's just not worth the end of the day, 10-point swing that you can have in a couple of minutes. So I like that idea, wait 30 minutes and then I'm always out at least 30 minutes before close all day. Same with Wednesday. I closed for, per position, probably like 320 or something, to make all, I made all Monday's loss back. And that's the thing. Like if I would have sat in, I think I would have been up 1,500 on it on Wednesday if I would have sat with it instead of like 700 and some when I closed. And I just closed it just to get out. So I'll test it tomorrow if we get a good setup and hold it most of the day and just be comfortable and know where my levels are. So I just want to share that.
No, man, that's awesome. And that's really the best part of the kind of, sit and wait approach. Yep. Is that if we sit back and kind of figure out where that pin is going to be, and it doesn't always work out. I'm not going to say, hey, this is a 100% guarantee, because it's not, especially on a high news day, or Jay Powell's talking and, right. And the word inflation gets brought up in any type of, conversation. But, it's one of those things where one of the things that we've kind of figured out or learned just kind of watching this is that, when the SPX moves the entirety of its expected move, it tends to then stay at that zone.
Yeah.
So if pre-market the expected move is 20 points, now the market opens up and SPX has moved 22, 23 points, it tends to stay in that zone almost the rest of the day, maybe plus or minus 4 or 5 points. But that's awesome because then you're just sitting here in this trade, just rocking back and forth at your pinpoint, and it you can feel, there comes a point in the day where the entirety of the expected move is now smaller than the width of your tent.
Yep.
And when you're in that position, man, you can sit back and be like, dude, this is awesome. Because even if it does make that move, that 8 or 9 point move, you're still under the tent. And the reality of it is that as long as you're under the tent at expiration, if for whatever reason you couldn't get out, if you're in this tent at expiration, you win.
Yeah.
Like even if over here tomorrow, you win $1,000,
Per
like you,
contract.
per contract. So that's the trick. What you don't want to be is hanging out over here, and if this is the pinpoint, you got in, you put in the trade too early, and this is where it's pinning. Yeah, I mean, ultimately, if it doesn't move too much, you're going to still win something.
Mm-hmm.
But over the course of most of the day, you're going to be upside down or barely profitable. And then in that last hour of the day, when pricing starts to get crazy and the bid asks go wonky, you're going to have a hard time getting out, and your position profit loss profile is going to be going from green to red to green to red, and you're going to be sitting there twitching as you're looking at it. I'm sure that's kind of what you experienced the day that you were in it with 10-15 minutes to go.
Dude, the last 30 minutes, I was actually shaking, and trading doesn't make me emotional very often. I'm not going to say it never does, but it's the way I play and the way that we play with the group and everything is a way that I can just monitor and adjust if needed, right? That's how almost all of our trades are. I was actually shaking, and I wasn't scared of losing anything, and I wasn't scared, like I just didn't know what was happening because it was every little point, like every few points it moved, it just completely shifted. So I didn't really have a place to gauge, like, when do I get out, when do I absolutely have to get out if this happens. Like, I was just sitting there watching price just go up and down drastically, and my P&L go from like 800 to 12 to 1,000, back to 700, back up to 1,100. And I was just, this
Yep.
was the last 30 minutes. I saw that fluctuation probably 8 times. And it doesn't, it's not like, oh, I felt sick to my stomach, but I was just like, I was shaking because I was like, what is happening? Like, I'm trying to understand this, and it's just losing its mind. So it
Right.
was like a mixture of like excitement, but also, oh gosh, like, am I doing the right thing here? I've never held it this close. So that's why I think I'm just going to get out every time, because anytime any sort of emotions brought into it, like, it's just, I remember it really fell on me right at the end of the day before it picked back up. And I was like, oh no, it just took like $600 away. I need to get out. And I was trying to fill the order, and it like filled at like 1,075 for both my contracts. I was like, oh, so it gave me a better fill this time. That's weird. Like, I was just like, I should probably just get out now. So yeah,
Right.
it's wonky.
And part of what you were seeing, and for those who aren't familiar, when you hear about option gamma, when you hear about like gamma risk,
Yep.
that's what that is. Because at the end of the day, when there's so little time left, especially for contracts that are in the money, and make no doubt, these two puts in the center here, they're both in the money. These are in the money the entirety of the trade, unless it's sitting right at 42.65. So at the end of the day, any little movement, the gamma on these trades has just exploded because they're in the money, and especially if it's close to the pin, and because gamma's high, what gamma does is for every dollar it moves, the delta, which is the pricing, will move a function of gamma. So gamma is going to go really high, and so then when it moves a dollar one way or the other, your option pricing is just going to go boop, and it's going to be a huge, 30, 40, $50 number.
Yeah, just
Um,
insane.
And that's what it is, and that's where the pricing goes all over the place. The bid ask gets all blown to heck, and it becomes very difficult to get out of the trade with a good fill because the bid, like I said, the bid and ask are all over the place. The pricing is all over the place, and in those last few minutes of the day, the this little tent or this little flag, if you're watching, it's gonna be going like back and forth, crawling back and forth between anywhere between a 5 to 10 point range, and that's not entirely uncommon for the S&P in the last 10 minutes of the day.
Mm-hmm.
So yeah, it can be a scary thing to be in this trade in the last few minutes. It can be very profitable if you hit that, if you hey, you want to roll the dice and you want to play that lotto ticket, it can be very profitable.
Definitely.
So um I want to bring up, so like one of the defenses we can do, I shouldn't say it's a defense. If you put on the trade and it continues and it blows out, one of the things that you can do, I don't necessarily recommend it, but you can do is you can close out the trade. And then if you feel confident that the new position it's at is the new pinpoint, you can go back in at that spot. You might be down $300-400. You close the trade, you reopen it at this point. And if you're not in day trade status, is and you've got more than $25,000 in your account, you don't have to worry about day trading. That's a legitimate defense to it. And in that case, I would probably just make back what I lost from the original trade, and I'd cut bait. I wouldn't necessarily stay in it all day. Try to recoup some of your losses. Um, I will throw it out there. One of the strategies that Ice Bear and I are looking into for a defense is actually throwing up a second butterfly if the first one starts to get tested on the side.
Oh, that's
And we're back testing this in Thinkorswim in the paper trading, where essentially you just have a second tent right here. And what that's going to do is that's going to make this break even higher because you're building a second tent to the right or to the left, depending on what way it goes. We haven't really fleshed it out yet, like how we would do it, like what points would go out and so forth. You obviously would need the capital to be able to put a second one on, but it's a strategy we're looking at. How would it work? How long do you have to hold both of them at that point? But it looks like it's a pretty valid strategy because you ultimately create a second tent, and you make it so that your take profit zone is obviously much wider, and what you're hoping for is it doesn't do a swing back in the total opposite direction.
right.
So more updates as we flesh that out. There will be more updates onto that.
Awesome. Is that everything you want to touch on today in this one?
Absolutely. I will tell you that I am working on like a paper strategy that kind of goes over this and talks a little bit about the Jim Olson strategy and why not to use it. So for members of the Discord, that should be done here within the next few days. It'll be up in my trade channel. It'll be pinned there along with all the other documents I've got there in my Dropbox. You can download it and have a pretty cool. It's a little snarky. You get a little bit of my Vance humor, my dad humor, my 80s, 90s, and 2000s references. So
That I don't really get. Some of them.
well, some of them. I mean, I'm pretty sure you haven't seen Back to the Future, so
Oh, I've
I
seen
don't know
Back
if you
to the
get it.
Future.
You've
I
seen
love
Back to the Future?
Oh
Okay.
yeah.
Okay.
Yeah. All right. We'll talk about it after this one.
Absolutely.
I appreciate you coming back on, Vance. If you guys have yet to leave a like, a comment, or subscribe on this video, please do that now as it helps us out. And we will see you guys in the next video.